6, 5, 4, 3, 2, 1, 0.
Welcome back to Beyond the Ledger, where we look past the numbers to uncover the strategies, risks, and opportunities shaping today's businesses. I'm your host, Shardae Layfield, and today we're diving into one of the most complex and increasingly important areas of compliance, multi-state income tax.
In today's conversation, we'll be breaking down key regulatory updates, compliance and exposure, and avoiding pitfalls. And joining today's conversation is Matthew Laney, a state income tax director at Bennett Thrasher with more than 15 years of experience in state and local tax. Matthew works with businesses across manufacturing, professional services, technology, and real estate, advising on strategic tax planning, nexus and apportionment, voluntary disclosures, entity elections, restructuring, and tax controversy, while also helping mitigate real estate transfer tax liabilities tied to corporate restructuring. Thank you for being here today, Matthew. Excited to have a conversation with you.
Thank you, Shardae. Me too. I appreciate that nice introduction.
Oh, you're welcome. So, are you ready to dive in? Let's dig in and learn.
Yes, absolutely.
All right, let's get with the first one. So, to set the stage, California is often one of the first states that comes to mind when businesses think about complex tax rules. Can you speak to the recent amendments made to the state's apportionment regulations and how they might impact taxpayers?
Certainly. First of all, I'd like to provide a little bit of background and context before we get into these amendments, and
Yes,
this will
great.
set the stage for our discussion. We do work with individuals, and feel free to reach out to me if you have any individual tax questions, but this discussion will focus mostly on business entities.
Mm-hmm.
So to start off with, business taxpayers that are subject to California income taxes and are also subject to income taxes in one or more other states are required to determine the portion of the income that should be reported on the California returns. Now, the starting point for calculating this California taxable income is the taxpayer's federal taxable income, modified for any statutory adjustments, such as an add back for state income taxes paid, and any sections of the Internal Revenue Code from which the state is decoupled. Once these adjustments are made, taxpayers then determine the amount of income that constitutes business income and the amount that constitutes non-business income. Now, these are terms of art, and states define them differently, but California, generally speaking, defines business income as income derived from transactions and activity in the regular course of a taxpayer's trade or business. Non-business income is all income other than business income. So, for example, let's take a law firm. So any fees received from clients for performing legal services would be considered business income because, of course, providing legal services is part of the regular course of a law firm's business. If a law firm, on the other hand, held a vacant parcel of land that it owned but never used and sold it, then that income would be non-business income because, of course, law firms don't regularly sell parcels of land. It should be noted that over the last few decades, there's been a trend for states to narrow the scope of what constitutes non-business income and a trend towards classifying all income as business income. Now, non-business income is subject to direct allocation, meaning that the income is subtracted from the taxpayer's tax base and allocated to a specific jurisdiction. In the example of if the land that was sold by the law firm was located in Utah, then the related gain would be subtracted from the California tax base and no portion would be subject to California income tax. Business income, though, is subject to apportionment among the states where a taxpayer does business. So this means that each state where the taxpayer does business may tax an apportioned amount of that taxpayer's adjusted income. States have a fair amount of leeway in determining the method by which income is apportioned to a state, but the method must pass muster under the U.S. Constitution and the state's Constitution. So states have historically required taxpayers to use an apportionment percentage calculated by an equally weighted three-factor formula consisting of a property factor, a payroll factor, and a sales factor. So these factors are fractions that are determined by dividing a taxpayer's in-state source amounts, the numerator, in other words, by the everywhere amounts, which is the denominator, and then averaging those three factors to determine the apportionment percentage. There's been a trend over the last few decades to have the apportionment percentage changed to where it's single sales factor rather than this three-factor formula. So states have been trending that way to the single sales factor formula. Under California law, the standard apportionment formula for businesses is the single sales factor formula. Now, this formula has been in effect since 2011, and for tax years that elected to use the single sales factor formula for that year. And it's been in effect for almost all taxpayers since 2013, when the single sales factor formula became rather elective but mandatory for general corporations. So the California apportionment percentage is determined by dividing California sales by everywhere sales. And once that percentage is calculated, you multiply it by the California adjusted gross income to determine the amount taxable in the state. So now that the stage is set, we'll get to the heart of the matter, how to determine the amount of sales to source to the California numerator. I just want to note that this discussion is going to focus on sales other than sales of tangible personal property, such as sales of services, because the amendments to the California sales factor regulations apply only to sales of other than tangible personal property.
Okay.
So historically, states have required sales other than tangible personal property to be sourced using the costs of performance methodology. And under this approach, you look to where the income-producing activity is. In other words, what is the essence of what is being paid for, and then you look at the costs incurred to generate this revenue, and where the greater proportion of those costs are incurred, that's where the sale would be sourced. Over the past 20 years, though, the states have shifted from this cost performance rule to a market-based sourcing method. And the market-based sourcing method, you generally look to where the market for your sale is. And in the case of services, there's different approaches. You either look to where the purchaser of your service receives the benefit, where the service is received, the location of the customer, or where the service is delivered. So California has historically required the cost of performance sourcing, but enacted the market sourcing rules beginning with the 2013 tax year. And in that year, the California Franchise Tax Board enacted a market-based sourcing regulation when the single sales factor apportionment formula and market-based sourcing were optional. Now, this created a lot of confusion for practitioners. They didn't know how to apply the rules. And so in January 2017, the Franchise Tax Board began a project to amend its market-based sourcing regulations and held its first informal interested party meeting on the subject. There were 6 total meetings held between 2017 and 2021 before there was even any proposal to adopt changes to the regulation. And on August 27th of this year, the amendments to the regulation were finally approved, and they became effective on October 1, 2025, but they're going to apply for tax years beginning on January 1, 2026.
Good to know.
So to continue, in general, California sources receipts from sales other than tangible personal property to the state if the taxpayer's market for the sales is in California. The regulations provide detailed assignment rules for various categories of gross receipts, including sales from services, asset management services, and intangible property. So services will be the main focus of the discussion. Sales of services are sourced to California to the extent that the purchaser received the benefit of the service there. Under the prior rules, sales of services to individual customers were default presumed to be sourced to California if the customer's billing address was in California.
Okay.
For sales of services to business entities, the benefit of the service was presumed to be in California if you look at the contract between the taxpayer and the customer, or the taxpayer's books and records kept in the course of its business. If those indicate that the benefit of the service was in California, you would source the sales there. That presumption was able to be overcome by the taxpayer, the Franchise Tax Board, by a preponderance of evidence showing that the benefit was somewhere else. Now, the changes to the regulation removes this distinction between sales to individual customers and sales to business customers, and establishes a single framework of presumptions for all customers, which focuses on where the benefit of a service is received when the service relates to real property in the state, tangible property used or delivered in the state, intangible property used in the state, or individuals that are physically present in the state at the time of delivery. Now, one thing to note is if a service is performed on tangible personal property, the sale resulting from that service is going to be sourced to the location where that property is ultimately delivered. So, for example, if you had a California customer who needed a mobile device prepared, and the customer shipped that device from California to Utah. The repair work was done in Utah, and then the device was shipped back to California. Even though the service was performed in Utah, that sale would be sourced to California under California's
Okay.
rules. So a couple of other points here. Taxpayers, again, can overcome these presumptions by a preponderance of the evidence, looking at their books and records, and if they can't determine it that way, they can come up with some sort of reasonable approximation. Sometimes, population percentage is used, and if none of those work, then the fail-safe is the customer billing address. Another point, asset management services. So the new rules provide fresh definitions and a sourcing framework for sales from asset management services. And so under these new rules, receipts from asset management services are sourced based on the domicile of the investor of the assets. So in other words, you don't source just to where the fund is located. You have to look
Right.
through that fund to where the investors are.
Okay.
And then from there, you have to determine how many, which investors are in California and what percentage, what their average value of interest in those assets that are held by the fund are in California. And so then you would know that percentage, and then you would determine the amount of sales to source to California on that basis. I just want to note that the rules for sales of intangible assets or any income derived from intangible assets have not changed greatly. There are some slight tweaks to it, but just be aware of that for any clients that might derive income from intangible assets. One final interesting point before we get to our second question.
Okay.
Is if there's a sale that is of a service and a tangible or intangible property, there's a rule that provides that in these cases you look to the value of each portion of the receipt that's readily ascertainable, and then each portion you have to apply the appropriate sourcing rule to it. And if it's not readily ascertainable, then again you go back to the contract and see what the purpose of entering into the contract was, and that'll lead you to determine how to assign the revenue. I'll note that you can visit the BT Insights page to find the latest commentary about the amended California sales factor regulations. So it's a very hot topic right now. I'm getting a lot of questions about it.
And thank you for the plug on the website.
Absolutely.
Okay, so moving to our next one and drilling down a bit, certain industries often face additional nuances within these rules. Are there any special rules for professional service providers, such as law firms and accounting firms?
Yes, and I'm glad you asked that. I have several law firms that I'm working with and how to apply these rules when they go into effect in 2026. So the rules, they provide a new definition for professional services, and it includes a number of enumerated services such as management services, tax services, audit and attest services, legal services, several other types of services. So there's now a new sourcing rule applicable to quote unquote large volume professional services. And that's defined as a single professional service provided to more than 250 customers during the taxable year. So if this rule applies, then receipts from large volume professional services are assigned based on the customer's billing address. So it seems a little bit more simple. However, there's an exception if more than 5% of the receipts from any one specific service are derived from one single customer, then the receipts for that customer fall under the general sourcing rules for services with those standard assumptions applied. And then you can use the contract and books and records to overcome that presumption, but you have to do a little bit more work for these larger customers.
Okay. Once taxpayers understand the changes, the next question becomes practical execution. So what steps should taxpayers take to comply with California's new rules?
Yeah, great question. It's always good to be proactive when these changes are upcoming. And I would say, generally speaking, service providers should forecast what services they're anticipated to provide to their customers beginning in 2026, since that's when the rules go into effect. And the application of new presumptions for service providers could produce different results under these new rules than they were under the old rules. So you should review your contracts and books and records with these customers to determine whether any of the new presumptions can be rebutted, and to where you can get to maybe a more favorable sourcing result. So while a comprehensive review is recommended, at the very minimum, taxpayers should review at least the material contracts in terms of sales amount. Okay. So, and for professional service providers, I would do a review of the types of services provided to customers and whether each specific service is expected to have that 250 customers or more. And so if you hit the 250 customer threshold, then The question becomes which of your customers is responsible for more than 5% of annual sales. Identify that could be one or more customers, and then you'll apply, the more detailed rules. And for customers for which the billing address sourcing is required, taxpayers, it's recommended that they review whether they have the correct billing address on file. Because in today's world, a lot of times invoices are just emailed to customers, and there's really not a whole lot of thought given to what address is put on there. So taxpayers should discuss which billing address to use with their customers, and there's no specific definition of what constitutes a billing address, but there is an assumption that you'll make a good faith effort to comply with the rules, and so pick a reasonable and defensible selection for a billing address, not just some peanut box or somewhere that you set
Right.
get out of the sourcing rules.
Right. So zooming out to the federal level for a moment, there's been a lot of conversation around recent legislation. And with the One Big Beautiful Bill being signed into law over the summer, will that have any impact on state income taxes for the upcoming filing season?
It could very well, yes.
Okay.
And the reason for this is because state taxable income is generally calculated by reference to the federal tax base. So when the act was signed over this summer, there were a number of changes to the federal laws, and those had various effective dates, with some effective in 2025, others for the 2026 tax year. So notable changes included an increase in the SALT deduction cap from $10,000 to $40,000, with a phase out for high earners, restoration of full expensing provisions for research and development expenditures under Internal Revenue Code Section 174, and changes to the allowable deductions for certain foreign income, which was formerly known as Global Intangible Low Taxed Income, or GILTI. It's now called Net CFC Tested Income, or NCTI. So I'm still trying to familiarize myself with these terms. One final point is that this act was signed on July 4th of this year, and that's when most state legislative sessions had adjourned for the year. There's certain states that are termed rolling conformity states, which apply the rules of the Internal Revenue Code immediately from the moment that they're enacted. These states, which include New York, will need to enact legislation to decouple from certain provisions of the One Big Beautiful Bill Act. There's other states like Colorado and Delaware. They're rolling conformity states, but they already convened special legislative sessions to address revenue shortfalls anticipated from conformity to the new rules, and they decoupled from most of those. There's other states, including our state of Georgia, North Carolina, and South Carolina, which are called fixed date conformity states. That's because they adopt the rules of the Internal Revenue Code effective as of a certain fixed date, and in most instances they'll need to pass legislation to conform to the new rules under the Act. So we're going to continue to monitor these developments into the new year, because state legislatures will typically reconvene in January, and we'll see what legislation is passed that may be retroactive to 2025.
Great insights. And so this is a question we hear frequently from growing businesses and remote sellers. If a company sells products or services to customers in another state, but has no employees or offices there, does it need to file a return with that state?
Right. Yeah, that's the old way of thinking that clients used to have. So I don't have any employees or any property in that state. I don't file. But that's not the case anymore. Over the past 30 years, we've seen an expansion of the concept of Nexus, or in other words, the minimum connection that's needed with the state before that state can impose a tax on you. So this all determines on what the level of sales are to that state, and if there's any other activity that goes on in there. So to take a step back, states have jurisdiction to tax corporations that are organized or commercially domiciled within that state. Out-of-state corporations can only be taxed if their contacts are sufficient to create Nexus. Now, the state income tax imposition statutes for the various states are limited by the Due Process Clause and Commerce Clause of the United States Constitution. So any rules that are enacted, they can't exceed those parameters. So the state Nexus standards generally fall into one of three categories. One is physical presence states, where you look to see if there's resident employees, owned or rented property, or frequent travel by employees or independent contractors in the state. There's not many of these states left. Delaware and Missouri are two, although they could arguably one day say that under their rules, a reading of it means that they're not a physical present state, and it can impose an economic presence. The second category is factor present states. Certain states, such as Alabama and Tennessee, have an apportionment factor presence nexus standards, which means that there's a predefined level of activity that an out-of-state activity that an out-of-state corporation should have with the state before that state can subject it to tax. And typically these thresholds are 50,000 of property, 50,000 of payroll, or 500,000 of sales in the state. And finally, we have economic present states, which is Georgia is an economic present state. And with these states, a taxpayer's economic activity within the state, such as making sales to customers or receiving royalty income for licensing intangibles in the state, may establish an economic presence and thus a taxable nexus. These states, they don't have a predetermined level of activity in the state that's going to subject you to tax, and so it's really more of a kind of touch and feel and risk tolerance analysis that's done to determine whether you have nexus with those states. So there's two important notes that businesses should keep in mind. So the first one is that service providers with customers in a state but no physical presence need to analyze the state's sales factor sourcing rules to determine the amount of sales to source to the state. And if the sales are substantial, which we generally define substantial as being 500,000 or more of in-state sales, then the business may have established nexus. There are certain states, particularly those that have market sourcing rules with the services delivered or benefit of service received language, that'll permit taxpayers to actually look through the direct customer and source sales to the location of the customer's customer. So in other words, you're looking to the end user or end recipient of your service or in making your sourcing decision. So if that look-through approach is applied and you have a large customer in one state and you've been sourcing all your sales there, you can look to see, well, is this benefit really received by the customer's customer, or maybe that direct customer has employees that are in other states that are using your service, and then you can take a position to source away from that state where your direct customer's headquartered. The second, businesses that sell tangible personal property to customers in another state and that have established nexus with that state may qualify for an exemption from that state's income tax under Public Law 86-272. Now, Public Law 86-272 is a federal statute. It was enacted in 1959. And what it does is it limits the ability of states to impose a net income tax on an out-of-state business whose activities are strictly limited to solicitation of orders for sales of tangible personal property. That's very narrow, the rules that you have to follow. And if you violate any of them, then you're not going to be able to claim that exemption. So under the law, a state may not impose a net income tax if your only business activity within the state is solicitation of orders of tangible personal property, and those orders have to be sent outside the state for approval or rejection, and if approved, they have to be filled by shipment or delivery from a point outside the state. A couple of points to keep in mind when developing an 86-272 position. The law only applies to net income taxes, so in other words, it won't get you out of sales tax collection responsibility or gross receipts taxes. The Texas franchise tax, that's a major tax for many of our clients. It is not considered a net income tax, and so you can't claim Public Law 86-272 protection if you're doing business or selling to customers in Texas. Again, you must look at the activities of all company personnel rather than just the sales personnel to determine whether any unprotected activities are being conducted within the state. In recent years, we've seen states such as New York and California expand the concept of 86-272 because, back in 1959, there was barely a concept of computers, no concept of the internet. And so what they're saying now is that if you, have a company that sells online and places internet cookies on a resident shopper's device for any purpose other than just tracking the shopping history or updating the shopping cart, or if there's any live remote chat assistance, that could result in loss of protection of 86-272 exemption.
Interesting.
A couple of common in-state activities that result in the loss of protection, that includes making repairs or providing maintenance on any property in the state, warranty services or providing technical assistance in the state, or installation or supervision of property that's delivered to the state. If you do conduct a non-protected activity in a state, if it's a trivial amount, which we technical term is de minimis, then that may not result in the loss of protection, even though that activity is considered unprotected. So we recommend that businesses conduct at least an annual Nexus review to ensure that they are properly capturing their Nexus footprint and in compliance with state filings. In doing that, you can find some opportunities to claim a no Nexus position or develop a more robust 86272 position based on the multi-state activities. And finally, if a business has multi-state activities for a number of years but only filed in a handful of states, that's really in our wheelhouse to do a Nexus study and exposure calculation for the last 3 to 4 years to determine if there were any filings that were missed and what the potential exposure is, the extent of that exposure, and whether remediation may be appropriate.
And then for entity structure can also play a big role in both tax savings and exposure. What should businesses that operate as partnerships be aware of from a tax savings and tax exposure standpoint during the filing season? And what about corporations?
Yeah, those are great questions. Not all entities are treated the same way among the states. We'll start with partnerships. And so there's generally 4 main things that I think partnerships should be aware of with respect to tax exposure or savings. The first one being Nexus. Again, we stress that you complete an annual Nexus review if you can, or even more frequently. If you can't do it annually, every couple of years or so, because the rules change so frequently and business changes so fast. You need to be able to stay on top of where you're required to file. So for federal tax purposes, partnerships are treated as pass-through entities, meaning that they reflect their income and other activity on information reports filed with the federal government and with the states where they do business, and the income is ultimately reported and paid on the returns filed by individual partners or corporate partners. Now, the states generally follow this federal treatment, although there's some that require partnerships to actually file and be subject to the tax rather than their owners. Tennessee, Texas, and New Hampshire are 3 states which impose entity-level taxation in lieu of imposing a tax on the owners. Second, and this is one that comes as a shock to many of my clients. So many of my partnership clients, they're surprised to discover that they may have a filing requirement and a requirement to issue state K-1s in states where a partner resides, but where the partnership does not have Nexus or do any business. And states that require a partnership return in state K-1 to be filed, if that's the only connection within the state and there's no other Nexus, includes our state of Georgia, Indiana, Missouri, New Jersey, New York, Oregon, Pennsylvania, and West Virginia. So I always keep a running list of these by my desk to make sure that
I bet.
have a resident partner there and a filing requirement. So if you have a resident partner there, I want to note that there can be some pretty substantial penalties for non-compliance. In New York, the penalty is $50 per K-1 per month for a maximum of 5 months, so $250 for a year. New York's rule only applies to the number of resident partners, residents of New York, for which you did not issue a K-1. Oregon, on the other hand, has a $50 per K-1 per month penalty with a maximum of 5 months in a year, so that could be $250 per partner, and this applies regardless of the residency status of the partners. So years ago, I had a large partnership client that had close to 150 partners, and it hadn't been filing in New York, and it just had the one resident partner. In Oregon, it had the one resident partner in Oregon, and so we were looking at I believe it was several million actually of penalty for the prior years. We were able to work that out, and I'll discuss how we were able to do that later. But just be aware that if you have a partnership structure, that is one of the big landmines that I try and advise our clients to look out for. 2 other points with partnerships: sales factor sourcing. Again, you want to make sure that you're sourcing your sales appropriately, making sure that you're not oversourcing or undersourcing to any one or more states. Special attention should be paid to states with high personal income tax rates, such as California, which has the highest marginal rate at 13.3%. And you want to see if you can source sales away from these states, because ultimately the income is going to be reported on the individual or corporate returns. In individuals, they're permitted a credit for taxes paid to another state on their resident state return, but that credit is allowed only to the extent of the tax that would have been paid on that sourced income if the resident state tax rate was applied. So with California, with the rate being so high, you could potentially result in double taxation of your income for state purposes. Corporate partners don't have the same credit mechanism, but they're permitted
Okay.
to deduct taxes in determining federal taxable income. However, on the state returns, they're typically required to add back these taxes to federal taxable income. So one last point for partnerships is pass-through entity tax elections are a quick way to save money for your partners. So with the Tax Cuts and Jobs Act, when that was enacted in 2017, it limited the state and local tax deduction for individuals to $10,000 annually. So this limitation, of course, has been increased with passage of the One Big Beautiful Bill Act, to where you can now deduct up to $40,000 with certain exceptions for high income earners. It starts to phase out, and this goes from 2025 through 2029. So this limitation impacted resident taxpayers in a lot of states, and in response, 36 states and New York City passed legislation to allow pass-through entities to elect to pay tax at the entity level rather than have the income reported and taxed at the owner level. I want to note that this opportunity applies for S corporations as well as partnerships. So if the election is made, what the practical effect of this is that state tax payment becomes a deductible expense for the partnership, which reduces the partner's Form K-1 income and lowers the partner's federal income tax liability. So while it's a state election, the benefit is seen in the reduction of federal tax. Now, most states require these elections to be made on timely filed original returns, and the election is typically made on an annual basis. So there's still an opportunity to make this election and get these savings. Some factors that you want to think about before making the election is eligibility for the PTET, because some states don't allow partnerships with partnership partners to make the election, even though there's been a general trend to relax this requirement over the last few years with several states. You'll also want to know what the PTET tax base is. So some states say that PTET tax only applies to the apportioned amount of income for a particular state, whereas other states like California allow a resident partner of California, allow his worldwide income to be subject to that PTET tax. He's getting taxed on a much bigger portion of his income, and then that's going to result in a much bigger federal benefit for him as opposed to a non-resident of California. Next, you want to consider estimated payments. Most PTET regimes require estimated payments to be made, and so you need to make sure to manage your cash flow and make sure you have the money to make those payments when they become due.
Right.
And finally, certain attributes can be lost if a PTET election is made. The states may consider that election, such as net operating losses and credits, the election to trap those tax attributes at the entity level. So in other words, they would not flow up to the owners. So you want to make sure that you're not in a situation where you have these NOLs and credits that might never be able to be used at the entity level.
Right.
One more point with C corporations. Again, you want to think about your Nexus and your sales sourcing profile. But two other planning opportunities are, one, you can purchase credits to offset tax. There's still time to be able to do that. And in Georgia, there's a lot of companies that are trying to sell film tax credits. So, often we'll connect our clients with credit brokers who are able to source some of these credits. And so our clients are able to purchase them, and that offsets the amount of cash tax that they have to pay for the estimated payments. And finally, elective combined and consolidated filings. So the default methodology for most of the southeastern states is separate company filing. So in other words, if an entity has nexus with the state, then that entity files and only reports its income and apportionment, as opposed to combined reporting states where affiliated companies would also be included with that filing. There are states in the Southeast, Georgia, South Carolina, Florida, Alabama, they allow for elective consolidated filings, even though their default filing method is separate filing. And so with these, what it allows you to do is each affiliated member of the group that has nexus with the state separately calculates its income and separately apportions its income to the state. And then once all that is apportioned to the state, it's consolidated, and then tax is applied to that. So the benefit of that is if you have a loss affiliate and a profit affiliate, once their income and loss is apportioned to the state, the loss is used to offset the income, so that can result in tax savings. So we recommend doing an analysis before you just make an election with these states, because a lot of times these elections are binding, and they're binding either for a number of years or in perpetuity. So you don't want to elect into something that's going to bind you for years, and that might not be helpful for you in the years to come.
No, that doesn't sound ideal.
Yeah, never just check the box. That's
Right, right. Pay attention, understand what you're doing, and plan ahead.
absolutely.
And jumping into the next one, but as operations expand, multi-state complexity increases quickly. So if a business operates in multiple states, how do you determine the amount of tax to pay to each state, and what are some common mistakes that multi-state taxpayers should avoid making?
Good question. And again, this comes back to how much income you source to a state under the state's allocation and apportionment rules. So essentially, you use the same or similar methodology to determine which income is allocable and which income is apportionable, and give some special consideration to calculating the apportionment percentage properly. A few things to keep in mind when allocating and apportioning income. So make sure to confirm that the sales factor sourcing treatment for states where you have large important customers is correct. Again, we discussed earlier, there's several states that apply that look-through approach. So if you've been sourcing all your sales to your major customer in one state, there might be an opportunity to source those sales elsewhere if you do a deeper review. Second, ensure that your business conducts a sales factor sourcing analysis on a regular basis. We typically recommend that annually, but at least every couple of years, I would say, is good to look at it. The state sales sourcing rules have changed over the years. For instance, North Carolina changed from cost of performance to market sourcing about 5 years ago. And certain states, such as Florida, while they have cost of performance rules on the book, on audit, they try to apply a market-based approach to get to the result to where more income is sourced to Florida. Make sure to consult with your tax advisor about ongoing apportionment litigation, though. I just mentioned Florida, how they've tried to shoehorn in the market sourcing result, even though it's a cost of performance state. Well, there's been some favorable taxpayer decisions in Florida over the year that you could rely on to develop a favorable sourcing position. Texas as well, there's been some favorable rulings, as well as in Pennsylvania. For service providers, sourcing sales to a customer's billing address may not be the correct default answer. For example, Massachusetts, the rules require, if you have sales of professional services, such as legal services or accounting services, that you source those sales to the location where the contract of sale is principally managed by the customer. So in other words, you could have a customer is headquartered in state A, but you're dealing with an employee of the customer that manages the contract in state B. Well, instead of sourcing to state A, you would source to state B, and that could be favorable depending on the tax rates among those two states. So if you can't determine where the contract is principally managed, then Massachusetts says you look to the location where the customer placed the order for the services. If that's not determinable, then you look to the customer's billing address as a default. So don't just go with billing address and call it a day.
No.
Of a deeper analysis. And so finally, businesses should also make sure to comply with sales throwback rules for sales of tangible personal property and sales throwout rules for sales other than tangible personal property. So, in other words, services. So if you have a manufacturer or distributor that ships product to a customer in another state and does not have Nexus in that state, it has to include that sale in the sales factor numerator return filed for the shipped from state. In other words, that sale has to be thrown back from the state you shipped it to the state where you shipped it from, if that state where you shipped it from has enacted a quote-unquote sales throwback rule. Now, a service provider, if sales are sourced to a state where that service provider does not have Nexus, it has to exclude that sale from the sales factor denominator in the states where it files, if those states have enacted sales throwout rules. So in other words, you remove or throw out those sales from the sales factor denominator. And the last thing, and this is one of those, I guess, the urban legends or something with state tax.
Share, okay.
They think that I have to source all of my sales to, 100% of my sales have to be reported on the, state tax returns that I file. Have to be right at 100%. It can't be 101, can't be 99%. That's not the case. You can have situations where you have less than 100% of your sales sourced on the returns that you file, and we refer to those unsourced sales as nowhere income. And there's instances where over 100% can be sourced on the returns, and so that's a result of different ways that the states apply their sales sourcing rules. And there's been Supreme Court cases that, where taxpayers, rightly think that they're being aggrieved when they have more than 100% of their sales sourced to the states. But the Supreme Court has held that, that's permissible because sometimes, they essentially said that's just life,
Right.
Sometimes
Oh,
it doesn't work out in your favor. That wasn't the
right.
technical,
Yeah, no, I get
well,
it. Just
yeah, yeah.
even well-run organizations can miss certain obligations. What are some common missed tax filings that you could share with us?
Two of the more common ones that I see missed are the California Limited Liability Company fee and tax and the New York Limited Liability Company and Limited Liability Partnership fee.
And
So
what
under
are
California
those?
law, an LLC that's taxable as a partnership for federal purposes
Mm-hmm.
or a disregarded single member limited liability company is required to pay the LLC fee based on receipts attributable to California. In addition to that, they pay the $800 tax. So the LLC's fee is calculated and reported on Form 568, Limited Liability Company Return of Income. And the fee is imposed on a graduated basis. So if the receipts derived from California for the year are more than $250,000 but not over $500,000, you have a fee of $900. If they're more than $500,000 but not over $1 million, the fee would be $2,500, and then it goes up and up, with the maximum fee being $11,790 for California sales over $5 million. Now, it's important to remember that the LLC fee is imposed on an entity-by-entity basis, and there's an exclusion for California receipts that were subject to tax to the LLC fee at a lower level that were passed through to the owner. You can subtract those when calculating your own LLC fee. And so depending on the organizational structure, if you have an organization that has a number of LLCs that are doing business in California, you could potentially have to where you're paying more tax than a similar organization that has the same amount of sales but fewer entities. So it's important to look at your structure and make sure that it's operating in an efficient manner with respect to the California LLC fee and tax. And for the under New York law, LLCs that are taxed as partnerships for federal tax purposes have to file New York Form IT 204-LL, Partnership, Limited Liability Company, and Limited Liability Partnership filing fee to report and pay the annual filing fee. Now, this fee is imposed on LLCs that derive any income, gain, loss, or deduction from New York sources. And the amount of the fee is determined on the New York sourced income for the previous year. So the lowest amount of the fee, if you have sales that are not more than $100,000, it's $25. If between $100,000 but not over $250,000, it's $50. And it continues to go up at a graduated rate to where the highest amount you would pay is $4,500 if the receipts are over $25 million. So it takes a lot of receipts to get to that highest amount of $4,500. A few other filings that I often see missed are states that impose gross receipts taxes. And so gross receipts tax is essentially a tax, as it implies, on the gross receipts sourced to a state. There's some limited exemptions or deductions that are allowed. And the rate of tax is usually a lot lower than an income tax. So be aware if you have, if your business operates in the states of Delaware, Nevada, Ohio, Oregon, Tennessee, or Washington, that those states impose gross receipts taxes. And this is something that we often see when a business is being sold or considering being sold. This comes up on due diligence, is that, the gross receipts tax filings are missed. And so if that happens, it's good to get ahead of it and remediate the exposure so that you're not having to deal with it when you're trying to sell your business. And finally, there's several major cities that impose local income taxes or gross receipts taxes.
Okay.
And these include New York City, Philadelphia, Portland, and San Francisco. So if your business has substantial sales or physical presence in those localities, make sure to consult your tax advisor to see how you should proceed, if you should file, or if you should go back and remediate any prior exposure.
So, and when something does fall through the cracks, there are often options available. But if a business overlooks filing in a state or has not filed in a state for a number of years, when it should have been filing, what can be done to correct this?
Yeah, and mistakes do happen. We see it all the time. Even the most, by the books type companies that try and follow the rules and be compliant everywhere. It's easy to miss something with all these states and the different rules. So in these situations, the first step, and I'll go back to it again, is perform a Nexus study, determine which states that the business should have been filing in, where it currently should be filing, then determine what the estimated tax penalty and interest exposure is in those states. Technically, the statute of limitations for assessment can stay open indefinitely if a return was required to be filed in a state, but it was not filed.
Okay.
In practice, however, we see states tending to have shorter look-back periods. In other words, they're not going to go back 3 decades and try to assess you for all those years, thankfully. So once the exposure is calculated, we then analyze all of our options for tax remediation. And so this can include back filings, applying for voluntary disclosure, prospective filings, or monitoring Nexus on a forward-looking basis. So back filings, those are typically not recommended unless there's only a few open tax years and the amount of tax exposure is minimal. I can't recall the last time I've actually recommended back filings to a client, but that is an option. The second, applying for voluntary disclosure. This is something that we do all the time, and there's lots of benefits to it. So with voluntary disclosure, we would recommend this in situations where a business has been a non-filer for a number of years, and the estimated penalty is at least anywhere from $5,000 to $10,000 or up. That's kind of the sweet spot for doing these. So the benefit of voluntary disclosure is that an applicant may anonymously apply to a state through an accountant or an attorney to come into compliance with the state's tax laws. And so if accepted into the program, states will offer a limited audit look-back period, which is typically the last 3 or 4 years worth of filings that were missed. And they'll agree not to audit any periods that begin prior to the earliest year in that audit look-back period. So in exchange, the business will file and pay taxes for the years included in the look-back period, and the state will agree to abate all of the penalties. And so this will get the company into compliance going forward and really give you peace of mind. And again, it's especially beneficial if a company intends to sell or otherwise exit the business, because it allows the owners to clean up prior exposures and get ahead of that before they actually go through the due diligence process.
Right.
Prospective filings may be appropriate if there's only 1 or 2 missed filings and the minimum tax was owed in the earlier years. Ultimately, we're never going to recommend that you don't file in a state. It's ultimately up to the business to decide whether to file a return or not, and that is based on their level of risk tolerance, the cost benefit of coming into full compliance. So the number of different factors that a business has to consider before it makes the decision. And finally, there's some businesses that may choose to monitor Nexus with the state on a forward-looking basis if there's some ambiguity as to whether Nexus was established, or if the company knows that it may not be doing business at any point going forward in that state. We'll see sometimes where companies will establish Nexus with the state, and it'll just be like a 1-year blip, and they know they're not going to do anything else in that state going forward. Oftentimes they'll say, well, we'll just let the exposure remain there, and we'll deal with it when it comes up. Again, not what we would recommend, but that's a decision for the business.
Right. And then to wrap things up and bring it all together, do you have any final thoughts that clients should keep in mind heading into the upcoming tax filing season?
Yes, I do. A few points. My advice would be, 1, talk to your tax advisor early and often to get a sense of the compliance timeline. Make sure to calendarize any deadlines for providing information and for any statutory filing deadlines. And also provide information to your tax advisor as soon as possible. The earlier you get the information in, typically the sooner you can get your returns back and filed, and then you can move on with the rest of your year. The next point is to conduct any Nexus or sales sourcing studies as soon as possible so that you allow yourself time to consider your filing or remediation options. I've got a number of clients that we're doing Nexus and sales sourcing studies for, and we're trying to get these done before February 15th because, extensions or returns are due March 15th or April 15th, so that gives several weeks to consider and mull over the options. Next would be to monitor the daily tax alerts for state adoption or decoupling from the One Big Beautiful Bill Act and any other changes that might be retroactive to tax year 2025. Again, make sure to touch base with your teams as often as possible. Typically I would recommend scheduling weekly check-in calls to make sure that things are moving along smoothly and to avoid any of that last minute deadline pressure so that you're not having to, pull any all-nighters on
Right.
That's never fun. I've done that a few times. I don't recommend it. And finally, so if there's any particular returns that are, complex or that will otherwise have a material amount of tax, consider, making an extension payment to make sure you get all your tax paid in. But, also file that extension so that after the original, filing deadline, you'll have some additional time to fully vet and analyze the issue and document, the complicated tax reporting issues and what your different options are. So, tax season's right around the corner. It's hard to believe. So
I know.
We've got Christmas coming up. So.
Right. So thank you so much, Matthew, for breaking down the complexities of multi-state income tax. Definitely
You're very
appreciate the insights and conversation, and hopefully to see you back on soon. Thank you so much.
Absolutely. This was a lot of fun.
Thank you.
That wraps up today's episode of Beyond the Ledger. Thank you to Matthew Laney for breaking down the complexities of multi-state income tax. From evolving state rules and filing obligations to practical steps businesses can take to manage risk and stay compliant. If today's conversation sparked questions about your own multi-state footprint, entity structure, or filing exposure, be sure to subscribe on your favorite podcast platform so you don't miss a future conversation. And to learn more about Bennett Thrasher's state and local tax and broader advisory capabilities, visit btcpa.net. We'll be back soon with more stories and insights from the experts shaping the way organizations plan ahead, uncover opportunities, and move forward. Thanks for tuning in to Beyond the Ledger. We'll see you again for the next conversation.